Okay, let's unpack this. Welcome everyone to the deep dive. Today we're digging into a fascinating topic based on your sources. Building a low-risk income strategy. We're talking options, specifically on the NSE, India's National Stock Exchange, and we're zeroing in on Reliance Industries as the main example.
Right. The mission here, as I see it from the materials, is to pull out the core ideas. It looks like they lean heavily on quantitative analysis, finding that statistical edge, and disciplined risk management. That's key.
Exactly. This isn't about swinging for the fences, hoping for massive gains. It's more about finding those practical nuggets, ways to navigate the options market with defined risk, aiming for that steady, consistent income.
And the sources, they start right off with a pretty clear mathematical framework. The objective seems straightforward. Maximize the premium income you collect
Ah,
while being really strict about minimizing risk. And they define risk quite clearly.
how so?
They specify it as keeping any potential loss under 2% of your total portfolio value per trade. Very specific.
Okay, wow. So it's really built on numbers and keeping those controls tight, stops losses getting out of hand. What are the main sort of quantitative signposts the sources point to for this strategy?
Well, there are several key metrics they focus on. First up, targeting low delta options, usually under zero point 0.3. Now, delta, as you know, tells you how much the option price might move for a 1 rupee change in the stock price.
Right.
So, targeting low delta means you're deliberately reducing your bet on direction. You're less dependent on the stock making a big move one way or the other.
Ah, okay. So you're setting yourself up to potentially profit even if the stock just chops around sideways or drifts a bit.
Precisely. The second thing is prioritizing theta decay.
Ah, time decay. Love that concept.
Yeah, theta is the bit of the option's value that just, well, evaporates as time passes towards expiry.
Yeah.
The sources suggest looking for options where theta is high relative to the premium, so you're essentially collecting rent day by day.
Getting paid while you wait.
Yeah.
Nice. What's next?
Third, selling options when implied volatility, the 4V, is higher than historical volatility, the HV. 4 is the market's guess about future swings baked into the price. HV is what actually happened in the past.
Hmm.
So selling when IV is higher means you're often selling when options are, relatively speaking, more expensive, capturing richer premium.
So potentially getting paid more because the market's pricing in more future drama than history might suggest.
That's the idea. And finally, aiming for a high probability of profit, or POP, often above 70%. This whole approach is really built on stacking the statistical odds in your favor, trade after trade.
Got it. So using these metrics as the guardrails, the sources then apply this to Reliance Industries. Known for being pretty stable, liquid, lot size of 250 shares, what are the main strategies they detail?
The first one they focus on is cash secured puts. Concept's pretty simple. You sell someone the right, but not the obligation, to sell you Reliance shares at a set lower price, the strike price, by a certain date. You collect premium upfront for that, but crucially, you need the cash on hand to actually buy the shares if the price drops below your strike.
Right. Cash secured. Makes sense. How do the sources say to apply this to Reliance specifically?
They suggest picking out of the money strikes, so below the current market price. And with that low delta we talked about, under zero point 0.2, they usually aim for about 30-45 days until expiry. That seems to be the sweet spot for decent theta decay without being too close to expiry. The goal, about 1-2% return on the capital you've set aside per trade.
Okay, can you walk us through their example? Numbers usually help.
Sure. Let's say Reliance is trading at 3,000 rupees. They look at selling the 2850 put, that's OTM. Let's say its delta is 0.15, fitting the low delta rule. And maybe the premium you collect is 30 rupees per share. So for one lot, that's 250 shares. The cash you need to secure the put is 2,850 times 200, which is 712,500 rupees. The premium you collect upfront is 30 rupees times 250 shares. So 7,500 rupees.
Right. And what's the return picture there?
That works out to about a 1.05% return on your secured capital for that trade period. If you could consistently find similar trades, that could annualize to roughly 12.6%. And importantly, the sources estimate the probability of profit for this kind of trade is high, maybe 85%.
85% chance it stays above 2850. Okay.
Yeah, high statistical likelihood it expires worthless, letting you keep the full premium. They mentioned Reliance's stability, its low beta, and liquidity helps here too. Tighter spreads, easier execution.
Okay, that makes a lot of sense for a stock like Reliance, where maybe you wouldn't mind owning it a bit cheaper anyway. What's the second main strategy from the sources?
That would be covered calls. Different angle here. With covered calls, you already own the underlying shares. Let's say you own one lot, 250 shares of Reliance. You then sell someone the right to buy those shares from you, but at a specific higher price, the strike, by a certain date. Again, you collect premium for selling that right.
Generating income on shares you already hold.
Yeah.
Got it. And the mechanics they suggest. Similar metrics.
Pretty similar logic, again, favoring out of the money strikes, so above the current price. Maybe a slightly higher delta tolerance here, like under 0.3. And targeting, say, 30-60 days to expiry, the aim is often for a 1-3% return per month based on the value of the shares you're holding.
Okay, and their example for this one.
So imagine you own those 250 Reliance shares at 3,000 rupees each. That's 750,000 rupees in value. You might sell a call option, maybe 45 days out, with a strike price of 350 rupees. Let's say the premium is 40 rupees per share.
Okay.
You collect 40 times 250 shares, which is 10,000 rupees in premium.
And the return and probability on that trade.
That's a 1.3% return on your stock's value just from that premium for that month or so. Annualized, maybe around 10.6%, roughly. And the probability of profit, around 80%. That's the statistical chance the stock price stays below your 3150 strike by expiry, letting you keep the premium and your shares.
So effective in flat or maybe slightly bullish markets.
Exactly. Good way to grind out income from a core holding. Oh, and the sources also give a quick mention to the iron condor.
Right, the range-bound strategy.
Yeah, another defined risk play. Good if you think the stock's going to stay within a certain price channel. They noted a poppy around 75% in their examples for that one, too.
Okay. So we have the strategies, the metrics, but the sources seem to really emphasize risk management. What did they highlight there?
Oh, absolutely non-negotiable according to these materials. Strict position sizing is paramount. Limiting any single trade to a small slice of your portfolio, maybe 2 or 5%. The idea is no single trade going wrong can cripple you. Keeps you within that under 2% loss target per trade.
Crucial. What else?
Monitoring overall market volatility. They mention things like the India VIX index. If VIX is high, maybe you adjust your strategy, perhaps add hedges. They also talk about the possibility of rolling options.
Adjusting the trade?
Yeah, if a trade moves against you, instead of just closing it for a loss, you might roll it forward in time or adjust the strike price to give it more time or room to potentially recover. It's an active management technique.
Needs discipline, I imagine.
Absolutely. And that's the final point they stress. Discipline, sticking to your rules, using the data available NSE option chains, maybe backtesting platforms, and not letting emotions drive decisions.
Right. So putting this all together, the metrics, the specific strategies like puts and calls on Reliance, the tight risk control, what's a potential outcome the sources suggest is achievable?
They seem to indicate that with proper execution and risk management, aiming for an annualized return from premiums in the, say, 8% to 15% range is feasible. But the big emphasis is on achieving that with limited and, importantly, defined risk on each trade.
Okay, so to recap this deep dive, your sources suggest that by really focusing hard on high probability of profit, using low delta options, and employing very disciplined risk management, using strategies like cash-secured puts and covered calls, particularly on stable, liquid stocks like Reliance, it seems possible to build a framework aiming for a lower risk income stream via options on the NSE.
Exactly. It provides a structured approach.
Yeah, this framework gives you, the listener, specific metrics and strategies drawn directly from these sources to think about if you're exploring ways to generate income with defined risk in the options market.
It leads to an interesting thought, though. Given how much these sources emphasize statistical edges and probabilities, how might focusing on these consistent, high probability, maybe smaller wins change how someone thinks about winning in the market? Compared to always chasing those big, less predictable home runs, something to mull over.